Hi again. So this time we're going to pick up on our big economy diagram that we had in the first video and look at some of what we call the macroeconomic objectives, which are basically a fancy way of saying what sort of things would we like to see in our economy? What sort of features do we want our economy to have? So the first thing that most governments and most societies would like to see in their economy is that GDP, basically the total amount of money moving around this circular flow, is getting a little bit bigger every year. Because as long as the growth in the amount of money is outpacing the growth in population, then we can roughly assume that the average household is receiving more income every year. And as long as we're happy to assume that households are fairly rational and that they're buying the types of things that will improve their lives, then hopefully that should mean that their lives can get a little bit better year on year. So if you look at this little simple diagram here, in an ideal world, over time, GDP would increase in an economy. Unfortunately, the truth is that that line, that linear growth pattern, very rarely happens for an economy. What we tend to see is economies having a cycle of strong growth and a weaker growth, strong growth and weaker growth again. Now, the economic cycle, as we call it, is nothing new, and it doesn't look like it's going to go away anytime soon. But certainly what we'd like to see is that economies don't have very aggressive, high periods of growth that may be destabilizing, and certainly nobody wants to see very low troughs in this economic cycle. So we'd like to see that cycle flattening as much as possible. So some common terminology there: boom periods mean periods where GDP is growing very, very rapidly and the money in the circular flow of income is going up very quickly. And a recession is when GDP is falling, has to fall for 6 consecutive months or 2 consecutive quarters. So all economies would like to avoid recessions, and we're hitting a recession now due to the coronavirus. The last recession we had was due to the financial crisis. The next thing we'd like to see is a low unemployment rate. So you'll remember from the last video that unemployment happens when you have households who are unable to find any firms to use their labor. There are households that have labor, but for whatever reason, the firms in the economy just don't want to use their labor at this point in time. Maybe their skills don't match the type of firms we have. Maybe the firms just don't have enough business at the moment to be able to employ them. Maybe they've got skills that were useful to firms but are no longer, and they're unable to retrain or move location. Lots of reasons for it, but no economy wants to see very high rates of households sitting there without a firm to go and work in. The next thing we might look at is how that income that's going to households is distributed. We'd like to see, from an economist's point of view, slightly more equitable distribution of income. It doesn't mean we need everyone to be on exactly the same income, but what we do observe is we observe economies that have got very wide disparities between the rich and the poor, having all sorts of social problems, issues of crime, issues of social cohesion that actually end up weakening their economy's growth in the long run. So a good example of a very unequal economy that has not gone well would be South Africa. Example of a very evenly distributed economy that has been very strong over time might be Norway or Sweden or Finland. The next thing is probably something that's quite technical, and it takes a little bit of studying to really understand what it is, what it means. But low and steady inflation, or in other words, the growth of prices in the economy, we'd like to see that relatively steady and not too rapid. So the prices in the economy are happening, of course, in these markets. When we go down to the shops, we buy something with our income, we have to pay a price for that thing. Now, the price of things tends to rise over time. As the amount of money in the economy rises, so too the prices of goods and services rises. That's okay. We don't want it to be really rapid, and what we don't want it to do is to be very volatile. We don't want it to have 10% price growth in one quarter and then 0% the next quarter. What the UK and many governments like to target is around about 2% price growth a year. Now, So understanding the reasons for inflation can be quite complex. I'm not going to do a little introductory video. But basically what happens when prices rise rapidly is that there's too much money in the economy chasing too few goods. In other words, the amount of money available is increasing at a more rapid rate than the number of goods and services that firms can manufacture or can create in a given time. Now, we could solve that by having a fixed amount of money in the economy, for example, just using something like gold, and there's only a certain amount of gold in the world, and so therefore the amount of money couldn't increase. But we don't go for that option. We actually have a currency that can increase over time. And where that all happens basically is over in the financial sector, over here. So in order to be able to control the rate of inflation, the government has to keep a close eye on the financial sector. In basic terms, they need to make sure there's not too much rapid lending in the economy. We'll go into that in more detail later in the course. All you need to know for now is that the government has its own special bank called the central bank. It's like the mothership of all banks. And that central bank controls, not completely controls, but regulates and tries to influence what happens in the financial sector. And they hope that that will feed through to prices in markets and make sure that that inflation rate doesn't get above 2 or maybe 3% in a given year. Doesn't always work out, but that's what they try and do. All that stuff there that happens over here with the government's central bank in the financial sector, we call that monetary policy. Of course, another way that inflation could happen is if the government are out there spending too much money too rapidly. And it's no surprise that we've seen periods of high inflation when governments suddenly increase their spending very rapidly during periods, for example, like war, when they're spending lots on military. So that will happen over here. The government has a role to make sure that its spending doesn't grow too rapidly and create inflationary pressure in the markets. So the fifth one and the final one that we'll talk about today, objectives that we like to see in our economy, is what we'd call, broadly speaking, the trade balance. The trade balance refers to the relationship between imports and exports in the economy. If our economy is importing more than it's exporting, or the amount of money it's spending on imports exceeds the amount of money it's earning from exports, then essentially it's running what we call a trade deficit. It means there's more money leaving our economy to buy fancy overseas products than there is coming into our economy from overseas buyers to buy our products. Now, it turns out that is actually the case in the UK. And we've been doing this for quite a while. It's a little bit of a concern in the UK economy. And that's what we call the trade deficit. So, to summarize, we want to make sure that our economy has got a number of things going on at the same time. It's not that easy to do, in truth. First thing is, we want to make sure that GDP is rising over time. That'd be ideal, but it's got to be sustainable, guys. It's got to be something that you can maintain over the long run, not some sort of bubble that just bursts. It also is increasingly, we're learning, needs to be environmentally sustainable, and it has to be GDP growth that's actually improving people's livelihoods. And there's been a lot of work done on that in recent years, trying to work out whether consistent GDP growth is actually helping to improve living standards. The next thing, of course, is that we want to have growth, but we don't want too many people to be left out. We don't want to have a whole lot of households with unemployed households. Households are unable to find firms in which to work. That's not good for any economy. In a similar vein, of course, while we have GDP growth, we want to make sure that we don't have households left behind. So we want to make sure that there's some sort of attention given to the distribution of income. There's no point in 1% of households getting massively wealthy this year and 99% of households actually getting worse off. That's not the type of economy we're looking for. The more technical one that'll take a while to understand is inflation. Basically, how quickly are prices in general in the economy going up. It's okay for prices to go up at a nice steady rate. We're kind of used to that. Around about 2% a year is fine. But we don't want to have volatile rates of inflation. We don't want to have high rates of inflation. And if you want to see examples of high rates of inflation, just type hyperinflation into Google or YouTube. Find out about what happened in Germany in the interwar years, or what happened in Hungary, or what's happened in Zimbabwe more recently. And of course, the most recent example is Venezuela, hyperinflation in Venezuela. Give that a quick Google. We do not want that to happen. And the final one then, the trade balance. It would be nice if we were a bit more like Germany, if we could export more than we import. In the UK at the moment, we haven't managed that. We are importing more than we're exporting. And that's okay. It means we get to drive nice, fancy German cars and that kind of thing. But in truth, guys, it does kind of mean that there's a long run question to be answered, which is how are we affording for that money to be leaving the economy more rapidly than it's coming back in? I won't give you the total spoiler, but basically the UK is doing a lot of borrowing from the rest of the world, and it's selling stuff off to the rest of the world, long run assets, in order to fund that. That's a bit technical, but to sum it up, there's 5 overall things we'd like to see in our economy, and if we can get them all to work together, that'd be fantastic. Truth is, most economies are doing well on one and then badly on the other, and you get periods where you think you've got a grip of, say, inflation, and you just try and get a little bit more growth in the economy, and then inflation kicks off. It's a balancing act, and it's really hard to get them all to be optimal at the same time. That's the joy of economics. Thanks for tuning in.